This is Jude Victor, your mentor for Forex and crypto trading. Okay, and today I want to talk to you especially on what I title How to Manage Losses in Forex. Okay, so I just said in Forex, but this can also be applicable in crypto trading. So now I'm going to just go straight to my chart and just quickly show you a few things, and also my position application is on, or my position website. So I would be using the position website to show you a few, and then also be using the trading view chart to show you some things on the chart. Okay, so I just want to wait for the chart to come up. Okay, just a minute. Alright, so the chart is up now. So how do you cut your losses in Forex and crypto trading? How do you cut your losses? It's actually very simple. First of all is, what is the account size? What is the account size? So you are into Forex and crypto trading for the first time, and you're wondering how to start, or the first thing to do. First of all, you have to consider account size. Okay, like if you see the position calculator, the first option here is account. Like imagine someone who wants to trade small accounts like $10. If you calculate the position for $10, you'll find that if the person goes in with a standard lot of 0.005, the person is risking about 0.1 USD in this particular trade. So this tells you that the only way you can be able to cut your losses or manage your loss for a small account like this is taking this particular kind of standard lot. Okay, and your stop loss should just be about 20 pips. There are some people who would want to manage this account and they want to risk 10% because of probably lack of patience and greed. Now when you are risking 10% of $10, it means you're going to be losing $1. Let me draw something to your attention. You observe that most brokers, when you are trying to take position for an account as small as $10 and you try to use 0.005 lot size, okay, you find out that the broker will approximate this to this. So automatically it means that you are now forced to use 0.01. Now you can see that even with 0.005, you are still risking $1, which is a lot of money for such an account. 10%. That's what you should be gaining. Okay, for some accounts weekly, this is a good weekly gain for big accounts. So how come it will be different for a small account? So if you are losing 10% of your capital, it's not a good way of managing your losses. So what it means is that in this case, since the smallest lot you could take in most brokers is 0.01 for an account as small as $10, then you will need to reduce the stop loss. Okay, so sometimes you might need to take let's say 8 pips, between 8 to 10 pips. Okay, so let's say you are taking 8 pips, calculate this, you see that it has, sorry, you still reduce this to 1%. Please trade only 1% of your capital. That's one of the wisest ways to reduce it. So you can see that the risk has dropped. Okay, the standard lot has dropped. Okay, and you are risking 0.1 USD. Okay, so this 0.1 USD is like saying 0.1 first thing. Then this now leads me to the second thing which I would love to talk to you about, and it is risk reward ratio. Risk reward ratio. So when you are trading, what is your risk reward ratio? Now, for people who trade bad risk, okay, first thing I said account size, second thing I say risk reward ratio. Now, please permit me, I'm going to leave my chart on because trading is on for the week, so I'm going to use most of the things you see on the charts. So these are my analyses that have been done for the week, and I'm going to use it for the rest of the week. So just pay attention to this area of what I'm using to explain to you. What is your risk reward ratio? There are some people who use 1:1, and I will explain what this means. Now, 1:1 means that you are actually risking, for instance, a position calculator is saying that your stop loss is 8 pips, okay, and you'll be losing 0.1 USD. So it is saying that you either gain 0.1 USD or you lose 0.1 USD. So that's the meaning of 1:1. Okay, now look at the difference. 1:2 means you are risking, you either lose 0.1 or you gain 0.2. You see that now? This is a bad risk management. This is a bad way to manage your loss, and this is a good way to manage your loss. Okay, then better still, 1:2 or 1:3 or 1:4. So the more your risks to reward, the higher your reward. That's why it's called risk to reward, or risk reward ratio. So it is risk to reward. So the 1:, the one here is your risk. So you risk small to get bigger reward. Okay, now this is why it is important. You cannot win every entry in forex trading. You don't target to win every entry. So you cut your losses for entries that you lose. You target a higher reward ratio, so that when you now win a particular entry, your reward for the one you have won can cover for the loss that you had in the previous. So this is one of the things you must pay close attention to, your risk reward ratio. Let's go to the chart. I talked about account size, and one thing I said about account size is about pips, right, for stop loss. So let me just show you this quickly. This is an entry I made just yesterday that came to our take profits. Let's assume you are taking this entry from here and you are risking this. Okay, could you see that you're risking 37.5 pips? 37.5 pips. This is not even a good entry for a $10 account. I'm going to show you entries for $10 account. So that's not your trade if you are trading $10. Okay, these are some of the mistakes some of you make when you are in a free signal group. Someone trading $100,000 comes to a free signal group and gives you a signal, and you come with $10 and you take the entry and your account is blown and you're wondering what happened. Now look closely here. You see this second one, this scalp that I did before this big move. Okay, let me show you quickly. Let me go to the 3 minutes time frame. I guess that will zoom it and make it bigger. Okay, now if you look closely, you observe that the risk reward to this one is 8.5. This is a good entry for a $10 account. Okay, so we are risking how many pips? 8.5, and we're targeting how many pips? 18.6. That's what we caught. We were actually targeting 33. Now 33 is more than 1:2. Why is it so? Because as you can see, risking 8.5 pips, right? And we are targeting 30 pips reward. Okay, and let's do the maths. You must be very good with maths when you are doing some of these kind of calculations, so you can get some things right. So let's do the maths. 30 pips divided by 8.5. Let's know what is the ratio now. It will give you 3.5. Okay, now it is clear that 8.5 pips to 30 pips is a 1 to 3.5 risk reward ratio. This is a good risk. It's a good stop loss for a small account as small as $10, and it's a good risk reward ratio. Is that okay? So that's something I wanted to show you for account size on the charts. So you are looking at your account size. You are looking at the standard lot you can use for small accounts. Now I've dealt with small accounts, so I want to go back to the kind of account I expect you to be using, $5,000. Okay, that should be the minimum of what you are using. Okay, then I'm going to use $5,000. Please permit me, that is the minimum I like to trade. So for $5,000 accounts, 1% is being risk. 20 pips most times is what I prefer, but anytime I have 10 pips, it helps me to be able to take more standard lots. Now can you see that the standard lot for 20 pips for 1% risk is 0.25, and you're risking $50. So let's go to the chart. $50 is at risk, right, for this particular entry. Okay, now this entry is more than 20 pips, so but let's assume it was 20 pips, so $50 is at risk, right? And I'm targeting, let's assume this is let's say this is okay, I think this was 75 pips when I checked it during the trade. Okay, so let's say we're targeting, well, we are expecting to lose $50, and we are targeting 70 pips. Okay, we are ready to lose 20 pips. Now this is what you do. You go straight to your calculations and you divide 70 by 20, and immediately you see your risk to reward ratio. It's the same thing with the previous one, which is 1 ratio 5, 1 ratio 3.5. okay, now that's a good risk reward ratio, and what it means is that if it goes to hit your 20 pip stop loss, you will be losing $50, but if it goes to hit your take profit, you'll be gaining 3.5 times the 50 which you were supposed to lose, which is 175 pips. Now, but as a smart trader, another way you can cut this loss is, instead of just targeting straight entry with your, remember the lot size is 0.25, right? One beautiful way to do this is you can divide this 0.25 by 3. Let's do that quickly. 0.35 divided by 3, and it will give you 0.116, right? So you can take first position 0.1, okay, with this entry, okay, and you wait to confirm if movement will go in your way, and after this break of structure you take another 0.1, okay, and then you wait to see if there's going to be a reversal or a retracement. You take another 0.1, okay, and you even have more lots than 0.25, because 0.1 times 3 is now 0.3, okay. You can even take another one to make it 0.4, and you are taking your first take profit at the first place, like here, where you are suspecting that price may react. and when you take maybe the first set of take profit and the last one you leave it for maybe this last take profit, you'll find out that you have been able to cut your supposed losses. Pay attention to that. I think I've been able to talk to you very well on managing with risk reward ratio. So let me just go back to that side where I'm talking about the points. Okay, so I mentioned okay, this is 3 minutes. Let's go to 15 minutes so our write-up can come back. I mentioned account size, then I mentioned risk reward ratio. Okay, account size, risk reward ratio. Then I want to give you the last one, which is should I say money exposure. I could have said capital exposure, but how about profits? So because of that, I will just put the two together. So whether you are in profit already or you are dealing with your previous balance, your money exposure is something you must pay attention to, especially when you are dealing with AI. So now you are taking an entry, and what are you exposing in the market? You can be the liquidity for the market. The AI, the algorithm is designed, or rather smart money is designed to take out some more money to make up for the liquidity in the market. So will you be that liquidity by exposing all your money, or you will use proper risk management, like the first thing I mentioned, watching your account size to know what you can risk, the pips you can take and the pips you can risk. Then secondly, the risk reward ratio. Will you pay attention to those things to now perfect your money exposure? So those two things, account size, risk to reward ratio, will help you to be able to manage how you expose your money. So let's go straight to position calculator. You will see that with this calculation, 1% risk is exposing just $50 out of this $5,000. So when it comes to trading, loss is part of the process. It's something you must learn. So there are days when you will have to lose, and there are days when you have to make profit. But what makes you a profitable trader is the fact that the days that you lose, you have calculated your losses, and the days that you gain, you have calculated your gain, such that your several gains have been able to put together to cover up for the losses. So your gain should always cover up for the losses for you to be profitable. So that's what it simply means. So let's take, for instance, first day you gain $10 your trade. Second day you lose $10 your trade. Okay, then fourth day you should gain $20. That's how it should be. So your risk reward ratio should be able to do this. So in gaining $20, though you gained $10 and lost this, you have been able to gain times 2 of what the previous experience is. That's what it should be like. Then the next time, if you're going to lose, you should know that for money exposure, you should be only able to expose all your monies to lose only $10. Okay, so you can still have a profit of $10. Then in the next day, which you might most likely win, you should be targeting a higher risk reward ratio, and let's say it's $50. In the long run, at the end of the week, by the time you put your profit together, you should be able to have at least $70. That is how to be a profitable trader. So you need to pay close attention to some of the things I have said to understand clearly some of the things that I have said. So what's the next thing I would like to let you understand in managing losses? For instance, blowing off. Many people blow accounts and they tell you that Forex is scam. Meanwhile, you are the scam. Now this is it. You are trading an account of $5,000 and you are risking 100%. You know, your risk is what increases your gain. There are those who want to trade 5,000 to make 5,000, or maybe $10 to make $10. It's the same thing. Look at it. For you to trade $10 to make $10, you have to risk $10. Can you see that now? So first of all, once your risk is 1%, there is no way. I have to reload that. Anytime I put 100%, it doesn't go back to 1%. I don't know why. Once your risk is more than 1%, are you ready to blow the account? That's the next question. So let's say this is 5,000. Take note, your risk is 1%. Take note, your stop loss is 20%. It's 20 pips. There's no way you can blow this account with this calculation. So people who blow accounts are people who do not calculate their risk reward ratio. They don't pay attention to account size. They don't pay attention to money exposure. So this is how you can manage your losses as to blowing up of accounts. Then how about these emotional results that people have when they are trading? Let me show you quickly. I'll use this entry to show you this quick scalp that we did here. Let me use the 3 minutes where it will come out clearer. You find people who come into a trade, for instance, and they're expecting the trade to move in their direction, and unfortunately it's not going to their direction. They are now trying to force the trade, or trying to make the trade do what is expected. In such cases, you calculate your loss like I've said at the beginning, and you take your loss, or you cut your losses. So you cut your losses in calculating it. Then when you see that market is not moving in your direction, you are expected to take your losses. So as a good trader, or as a professional trader, one thing you must learn to do is to cut your losses and to take your losses. Calculate your losses and then take your losses. So with all the calculations I've shown you with this, you can see that the position calculator is not calculating profit, it's calculating loss. So you see, it's expecting you to lose. So I don't know how traders come about the idea of always wanting to win all trades. You cannot win all trades. You can only manage your entries to be a profitable trader. That's the only thing you can do. So this is it now. This is the 3 minutes, and I want to show you this as I round up this particular session. So imagine someone who took this entry, it got here, reversal is about to come, retracement is about to come, and at this point is in loss, okay, 8 pips loss, but yet he's coming to take more entries because of this move here to see if he can be able to survive, and all of a sudden the price goes in this direction. The next thing you hear is market is working against me, or market went in that direction because of me. That's how most of such traders speak. But what you need to know is that market is actually bigger than you. Yes, of course, market has a psychology, but market is bigger than you. Market is full of a lot of people, so it's not necessarily doing that because of you. Okay, it's working against you in that manner because number one, your psychology is wrong, and number two, you've not learned how to calculate your losses and rather cut your losses to take your losses. So that is one part I just thought to use to close this particular session of teaching you on how you can be able to manage your losses. So that's it. So as a good manager of losses, you will be a good profitable trader. See you in my next video.